Investing in real estate in Spain can offer strong opportunities, but the outcome will often depend on different key factors, such as the investor's tax residency, the type of asset acquired, the intended use or destiny of that asset, and the legal structure through which the investment is made. A rental property, development land, or a refurbish and sell project might each interact differently with Spanish tax rules, and none of these investment models is ultimately linked to a specific investment structure. The applicable regime could fall under personal income tax, non-resident income tax, or corporate income tax, and even vacant properties might, in some cases, trigger deemed taxable income. Where the investor is non-resident in Spain, the relevant double tax treaty might also influence how income and capital gains are ultimately taxed. The tax position on exit might vary depending on whether the property is sold directly or through a corporate structure. For that reason, these elements are usually best analyzed together before committing capital. When assessing a real estate investment in Spain, it is important not only to analyze the property itself, but also the tax framework in which the investment will operate. The investor's tax residency, the nature of the asset, the intended use of the property, and the structure chosen to hold it may all influence the effective taxation during the life of the investment and on exit. No single structure can be considered inherently optimal for a given type of project. Where the property is acquired by an individual resident in Spain, rental income will generally be subject to personal income tax at progressive tax rates. Certain operating expenses might be deductible, and residential leases can benefit from specific tax reductions in some cases. If the property remains vacant, the Spanish tax legislation may impose deemed rental income taxation. On disposal, capital gains will typically fall within the savings income regime. For non-resident investors, Spanish source income will ordinarily fall within the non-resident income tax framework. European Union and Economic European Area residents are, in principle, entitled to deduct rental expenses when determining taxable income. For non-European Union investors, taxation generally applies on a gross income basis, although this area is currently under review by the Spanish Supreme Court, following earlier national court decisions on its compatibility with European Union law. On exit, capital gains are typically taxed at a flat rate, with statutory withholding at completion. Where property is held through a Spanish company, rental profits will generally fall within the scope of corporate income tax at a flat rate. This may produce different cash flow profile compared to personal ownership, particularly where profits are retained rather than distributed. Dividend payments could trigger additional taxation at shareholders' level. From an exit perspective, the investor may dispose on the underlying asset or sell the shares of the company, and the tax outcome could differ materially between two approaches. Where a foreign company holds Spanish real estate without creating a permanent establishment in Spain, Spanish source income will generally be taxed under the non-resident income tax regime. As explained, deduction rules may vary depending on European Union status and ongoing judicial interpretation. If the level of activity were to constitute a permanent establishment, corporate income tax obligations could arise instead. Where transactions take place between a shareholder and a Spanish company holding the property, such as financing or use of the asset, Spanish related parties valuation and transfer pricing rules may apply. This requires arm's length pricing and may affect both deductibility and income recognition. Throughout the investment life cycle, the way in which the asset is used, whether for passive rental, active redevelopment, or resale, might influence how Spanish tax rules apply in practice. The same legal structure might produce very different results depending on this use and purpose, and conversely, similar projects might justify different structures. In practice, structuring a Spanish real estate investment is a multidisciplinary factor exercise rather than a formula. Tax residency, asset profile, investment strategy, financing, and exit planning all interact in determining the overall tax position. Because of this complexity, a tailored legal and tax analysis at the outset might help reduce risk and improve predictability on the investment outcome.